me tell you a true story about immunization, okay? When I was a little boy in New York City in the 1940s, we swam in the Hudson River, and it was filled with raw sewage, okay? We swam in raw sewage, you know, to cool off. And at that time, the big fear was polio. Thousands of kids died from polio every year. But you know something? In my neighborhood, no one ever got polio. No one ever. You know why? Because we swam in raw sewage. It strengthened our immune systems. The polio never had a prayer. We were tempered in raw shit. So personally, I never take any special precautions against germs. I don't shy away from people who sneeze and cough. I don't wipe off the telephone. I don't cover the toilet seat. And if I drop food on the floor, I pick it up and eat it. Even if I'm at a sidewalk cafe in Calcutta, the poor section, on New Year's morning during a soccer riot.
You know, he reminds me so much of my dad, because when I was growing up, it's like, you know, there was no boundary, right?
Right.
It's just, if you get hurt, get up, walk it off, rub some dirt on it, quit your whining. You know, we talked about the stories, of course, you know, my dad growing up, you know, having to walk uphill both ways to school.
In the snow.
In the snow.
Yeah.
Fighting polar bears with loose leaf notebooks, you know, that type of thing.
In Lake Jackson.
Exactly. I told you it was in Tyler.
Oh, behind the pine curtain. I forgot.
Tyler, Texas. Yes. So anyway, but yeah, it's just, he's a lot like those. That's the stuff I grew up with my dad.
Right.
Like, you know,
who needed George Carlin when you had your dad around?
Exactly. We were talking about our kids growing up, because we, you know, put our kids into swim lessons and, you know, did it all the right way.
Yes.
You know, as opposed to my dad, who just threw me into the deep end and said, if you swim back, you survive. So
you can do it.
You can do it. So yeah, you know, it was different. You know, it was growing up in our age, you know, back in the day.
How did we ever survive the 60s?
Exactly. But to George Carlin's point, that's the way we grew up.
Right.
And I don't get sick. I don't go to the doctor. I don't catch the flu.
You know what? Knock on Formica, I have been healthier this year.
Yeah.
And I think part of it's because I've been in this room all day away from all these sick people.
No, that's the thing. You know, everybody else brings their stuff in.
Right.
Just stay away from me. I'm fine. I don't get sick. You don't get sick. We're good. So let's just keep that way. Russell, he doesn't get sick because he's stuck in a room all by himself,
right.
just like you are. So maybe this is the thing, right?
Mm-hmm.
Anyway.
Our own little cocoons.
All right. So just before the break, talking a little bit about what the Fed's going to buy here. And here's the actual announcement from the Federal Reserve. As specified in the term sheet, the SMCCF, that is the corporate bond purchasing program that the Federal Reserve launched back in March. Now, they haven't done anything up to this point. They announced that they were going to do this, but they haven't done anything yet. So this all starts today. They're going to purchase U.S.-listed ETFs whose investment objective is to provide broad exposure to U.S. corporate bonds. Okay, great. Fantastic. Also, high-yield bonds. So they're also going to buy junk bond ETFs as well. To expedite implementation, the program will begin transacting with primary dealers that meet the eligible sellable criteria and that have completed the seller certification material. So primary dealers are the 20 primary major banks that operate around the world to buy treasuries from the U.S. government. So when there's a deficit and the Treasury needs to issue bonds to fund the deficits, this is how we get extra money. So if you take a look at tax revenue right now, it's completely just plummeted. So the tax revenue has fallen off the cliff because there's no activity in the economy, right? So nobody's paying sales taxes, blah, blah, blah. So tax revenue has completely declined, and we're issuing a tremendous amount of debt to fund the spending that the government wants to do. So not only do we have our normal spending for mandatory spending, Social Security, welfare benefits, interest on the debt, national defense, et cetera, but we're now issuing also debt to cover the payroll protection program, the additional unemployment claim insurance that we're going to pay, all this other stuff that the government's doing, these $2 trillion programs that the government's doing, we have to fund that through debt. So when the Treasury issues debt, these 20 primary banks, Goldman Sachs, JP Morgan, et cetera, they're the buyers. So they buy the bonds from the Treasury, and then normally they're supposed to sell them to, individuals, companies, pension funds, et cetera. And they hold the bonds and they collect the interest of the government. But now what happens is these banks buy the bonds from Treasury, turn around, sell them to the Fed. And the Federal Reserve is now financing about 100% of the total deficit of the United States. That's no small number. That'll be well in excess of $4 trillion by the end of this year. So throwing on top of that, they're now going to buy these exchange-traded funds. This is the first foray into buying individual securities through the Fed. Now, these are still bonds, so the Fed's still trying to provide the cover that they're only buying bonds, but this is the first step towards actually buying equities down the road. They're not going to buy equities until there's another sell-off in the market. So we'll get another 20% decline in the market sometime later this year. As an example, then they'll come in, they'll start buying actual exchange-traded funds. And that will literally be the end of the free market as we know it when we get there. We're not there yet, but we're going to get there. This all starts today. And as I was saying before, here's the interesting thing. BlackRock is the biggest issuer of ETFs, and they have now been tapped on the shoulder. Of course, Larry Fink and the guys that are all kind of run around, the Wall Street group, have very close ties to Steve Mnuchin, who's former Goldman Sachs guy, and Jay Powell. This is all kind of an insider club, right? And so naturally, when the Federal Reserve needs to find somebody to run the special purpose vehicle, you go to your buddy at BlackRock and say, hey, will you do this? And he's like, sure, I will. And you know what? I'm going to charge you. I'll give you a special deal. I'm gonna give you my best rate. I'm going to charge you 3% fees to sit on cash. And then when I actually buy these ETFs, I'm going to charge you an annual fee just to sit on these ETFs that I buy for you in the special purpose vehicle. We're not going to do anything with them. We're just going to buy them, and then we're going to sit on them. We're not going to manage them. We're not going to buy and sell them. We're not going to trade them. We're not going to try to make money with them. We're just going to buy them for you, pay them in an account, and we're going to charge you 2 or 3% a year. And what happens is that BlackRock's going to make a tremendous amount of money in the first year, and then every year after that, just for sitting on these securities. Now, when does this end? It never ends. Here's the statement from the Fed. Corporate debt buying, including ETFs, will occur in 3 stages according to the agreement: a stabilization phase, an ongoing monitoring phase, and a reduction and support phase. Purchases will be focused on reducing broad-based deterioration of liquidity seen in March of 2020. But again, as I stated, where's the broad-based deterioration when you have record issuance of bonds and there's plenty of uptake for it? There is no deterioration, but we're doing it anyway, to levels that correspond more closely to prevailing economic conditions. So they want to get the bond market back to where it was in January, February, before everything kind of went to heck in a handbasket. This is the actual quote from the Fed. Once market functioning measures return to levels that are more closely but not fully aligned with levels that correspond to prevailing economic conditions, broad-based purchases will continue, not stop, will continue at a reduced, steady pace to maintain those conditions. So this program is designed to never end. There is now a guaranteed buyer of bond ETFs forever. So we now have a permanent state of QE, quantitative easing, federal support, in both the Treasury market, the corporate bond market, the muni bond market, and now even in the ETF market. And while this sounds good on the surface, right? So there's a bunch of people right now running around. It's like, this is great, right? Markets are going to go to all-time highs and just never go down again. Go take a look at the Nikkei. The Nikkei is at the same level it was in 1990. And yet, Japan owns 80% of the ETF market. They have 250% of debt to GDP. And the Bank of Japan is on never-ending QE. So there is limits to the effectiveness of this. And when you destroy free market functioning, there's other unanticipated consequences of this. And the most important one is the expansion of the wealth gap between the top 1% and the bottom 99. You know, we saw that the top 0.1% own more than half the wealth of the population. That is going to become even worse as we do this going forward, because the actual actions by the Fed is a wealth transfer system from the middle class to the rich. We have a report on this on the website, by the way, called "The Fed Has No Option But to Expand the Wealth Gap." That's on the website now, realinvestmentadvice.com, along with our article today, which is "Stocks Aren't the Economy?" ? We go through the complete analysis that, the economy makes a lot of sense here and has a big input to the markets. That's on the website now, realinvestmentadvice.com. Stick around. Chris Salcedo's coming right up.
It's a rich man's world.